Ever notice how people treat the stock market like an emotional roller coaster? One day they're celebrating because their stocks are up, and the next day, they're acting like the world is ending because the market crashed. But what are they actually buying? And how can owning part of a company make someone rich over time? Today, we're breaking all of it down in the simplest way possible. What is a stock? A stock is basically a small piece of ownership in a company. When you buy a stock, you're literally buying a tiny portion of a business, which is either genius or terrifying depending on the day. But that means if the company grows and becomes more valuable, your piece can become more valuable too. Picture this. Imagine the biggest tech company was a huge slice of pizza cut into 1,000 slices. Each slice represents a share of the company. If you own one slice, you own a small part of the whole pizza. The more slices you own, the bigger your ownership becomes. Real companies work the same way, except instead of pizza slices, they use shares. Buying a share is like saying, "Yep, I want a piece of this company." For example, if Google was split into just 10 shares total, owning 5 would mean you own half the platform. Companies like Apple, Amazon, or Tesla are divided into millions or even billions of shares that people can buy and sell every day. Now you're probably thinking, why in the world would a company sell pieces of itself to random NPCs? Here's why. Because businesses need money to grow. A company might want to open new stores, hire employees, create products, or expand into other countries. All of that costs money. One option is borrowing from a bank, but loans have to be paid back with interest. Another option is selling shares to investors. In exchange for money, investors receive ownership in the company. That money helps the business grow, and investors hope the company becomes more valuable over time. A simple example. Let me break this down with a quick story about Tom and his gaming lounge. Tom wants to open a gaming cafe called Level Up Lounge. He calculates that he needs $200,000 to launch the business, but he only has $100,000 saved. Instead of taking out a huge loan, Tom decides to split his company into 100 shares. Since he already invested half the money himself, he keeps 50 shares and sells the other 50 to investors. Each share costs $2,000. Ethan, who spends way too much money on gaming setups, hears Tom's idea and thinks, "Yeah, I definitely waste my paycheck there." So Ethan buys 5 shares for $10,000. That means he owns 5% of the business. If the cafe becomes successful and the company grows in value from $200,000 to $1 million, Ethan's ownership becomes much more valuable too. His 5% stake would now be worth $50,000 instead of the original $10,000 he invested. Now he has $40,000 of profit to spend on V-Bucks. That's how people make money investing in stocks. But stocks can also go down. Investing isn't always peaches and cream. What if Level Up Lounge fails to attract enough customers? What if newer gaming cafes open nearby with better equipment, cheaper prices, and bigger tournaments? Let's say the business struggles and its total value falls from $200,000 down to only $100,000. Remember Ethan? He bought 5 shares and owned 5% of the company. When the business was worth $200,000, his shares were worth $10,000. But now that the company's value has been cut in half, his ownership is only worth $5,000. That means if Ethan sold his shares at that point, he would lose half of the money he originally invested. And that's the risk of stocks. When businesses succeed, investors can make money. But when businesses struggle, investors can lose money too. Dividends. Some companies also reward investors by sharing part of their profits. These payments are called dividends. Think of it like getting paid simply for owning part of the company. Not every business pays dividends, but many large companies do. Where do people buy stocks? So where do people actually go to buy and sell these little pieces of companies? People buy and sell stocks on something called stock exchanges. Think of a stock exchange like a giant sneaker convention where people buy and sell shares instead of shoes. The two biggest ones are the New York Stock Exchange and NASDAQ. Years ago, people had to physically trade stocks in crowded buildings filled with traders yelling across the room. Today, almost everything happens online. You can buy stocks directly from your phone using investing apps in just a few seconds. When a company gets large enough, like if Tom's Gaming Cafe, Level Up Lounge, expanded across the country with hundreds of locations, the company could decide to go public by putting its shares on the stock market. This would allow regular people everywhere to easily buy and sell ownership in the business. Common stock versus preferred stock. There are different types of stocks, but the two main categories are common stock and preferred stock. Think about it like going to an NBA game. Common stock is kind of like sitting in the nosebleed seats, while preferred stock is more like having courtside seats. Both tickets get you into the same game, but the experience and benefits are different depending on which one you have. Common stock. This is the type of stock you most likely think of when you hear stock. When you own common stock, you usually get voting rights in the company. That means you can vote on certain business decisions, like helping choose the people who help run the company. Now realistically, if you only own a few shares, your vote probably isn't changing the entire company overnight. That's kind of like yelling advice at an NBA coach from the nosebleeds and expecting to get signed to the team. But the more shares you own, the larger your dividend payments can become. Common stock also has the biggest growth potential. If the company becomes more successful over time, the value of your shares can rise a lot. That's why many investors like common stock. There's more opportunity for larger profits. But there's also more risk. If the company struggles or goes bankrupt, common shareholders are usually the last people in line to get paid after debts and bills are handled first. And sometimes, there's not much left by the end. Preferred stock. Preferred stock is more focused on stability and consistent income. Preferred shareholders usually don't get voting rights, but in exchange, they receive different benefits. The biggest advantage is guaranteed dividends. Preferred shareholders are usually paid dividend money before common shareholders receive anything. It's kind of like front-row ticket holders getting early access and better perks before everyone else enters the arena. Preferred shareholders also get priority if a company shuts down or goes bankrupt. That makes preferred stock generally less risky than common stock. The downside is preferred stock usually doesn't grow in value as much. So while common shareholders are hoping for massive growth, preferred shareholders are usually looking for steadier and more predictable returns. At the end of the day, it all depends on what you want out of investing. If you're chasing bigger growth and can handle more risk, common stocks are probably your lane. But if you'd rather have steadier income and less market chaos, preferred stocks might fit you better. Why do people invest in stocks? At this point, you might be wondering, why would I risk investing in stocks when I could just keep my money safe in a savings account? Here's why. Keeping money in a savings account is safer, but it usually grows very slowly, around 1 to 2% on average. Stocks have historically produced much higher returns, around 7 to 10% over long periods of time, which is why so many people use investing to build wealth. Of course, the stock market goes up and down constantly. Some years are amazing, other years are terrible. But long-term investors are usually focused on where their investments could be years or even decades from now. Important beginner advice. If you're just getting started, here are a few simple rules many investors follow. Don't put all your money into one stock. Invest in businesses you actually understand. Think long-term instead of trying to get rich overnight. Don't blindly follow hype on social media. A lot of beginners lose money because they treat investing like gambling. Real investing is usually about patience and consistency. The big takeaway. At the end of the day, stocks are simply ownership in real businesses. If those businesses grow, your investment can grow too. If those businesses struggle, your investment can lose value. That's why learning how stocks work is so important before investing your money. Hopefully this video helped make the stock market feel a lot less confusing. If you enjoyed this breakdown, make sure to like the video and subscribe for more simple explanations about money, investing, and financial freedom. And comment below, what financial topic should we explain next?